Perhaps you've heard the horror stories when it comes to credit cards, how it can ruin your life. It can put you in a lot of debt. It can also tank your credit score, which is entirely true. And this video actually came from a conversation that I was having with an individual earlier today about credit cards, the dangers of credit cards, and really the advantages of credit cards that I have. No, overall, parents thought credit cards were evil, credit cards were bad, but that is not really the case unless you are not using them as a tool and if you're not using them properly. Now, and today we're going to talk about the dangers of credit cards because I feel like this is probably one of the places that a majority of people are really underrating what kind of trouble the younger generation can get in, as we're looking at almost $1.1 trillion in credit card debt as a nation. This can be almost a pandemic, guys, when it comes to the debt relief. Number one, getting into the credit card debt. Now, if you really have the wrong attitude about credit cards, it is very easy to borrow much more than you can pay back, which starts almost this snowball effect with the credit limit that you have on the card. This again can adjust your credit. This again can make a very big difference. Now, a lot of people understand a couple of kind of inconsistencies or things that are not accurate with credit cards. Number one, you must always carry a balance. That is not true by any means, guys. Pay off your credit card and pay off your credit card in full every single month, and you'll actually be rewarded with two things. Number one, capacity of the card will stay at 100%, meaning the relationship between what you have available in relationship to what you have borrowed will stay at 100%, meaning you do not owe anything. Second one is, of course, you are not going to pay interest. You only pay interest on the balance that you carry forward. And for a majority of cards, you're looking at 22 to 25% minimum interest on that card. So when you think of interest, the way that I put it, and I've kind of said this a lot of times, is when you look at interest, whether it is a mortgage, an auto loan, a credit card, an unsecured loan, student loan debt, it is money that is coming from your paycheck to just pay your creditors. You're paying your banks, your financial institution, whoever is lending you money to have the items in your life. Now, this, of course, can be kind of offset if you're paying cash for it, if you're paying down debt, if you're eliminating debt. It is going to be imperative that you eliminate the debt. That way you can get your paycheck back. Now, a way to think about it, guys, if the credit card has a $2,000 limit, never spend more on the card than you can repay. If you do, you're going to be paying additional amounts. And credit card companies have also made the minimum payments so incredibly low, which I know this changed a little bit ago, a couple years, with people having to pay back more towards their monthly payment than they have in the past. If you look at your credit card statement, again, really take a deep dive and analysis of how much money you're paying in interest. Number two, also look at most of the statements have you will pay your credit card off in X amount of years if you're paying the minimum balance. I've seen ones that are you're paying $400 a month. It's going to take you 17 years to pay off this balance, which in my opinion, guys, is kind of crazy. There's so much technology out of there. There's apps, there's budgeting tools. You can track your spending. It's incredibly easy with a lot of the advancements in technology to make it a lot more easy to go through the budget. Now, number two, guys, missing your credit card payment. This can really have a massive factor in really two parts. Number one, payment history is 35% of your score. If you're missing a payment, this can have a serious detrimental impact to your credit. Number two, if you're using a majority of the capacity of your card, that is your second 30% of your credit score. So the combination of those two covers 65% of the credit card, guys. In addition, there can be fees if you're late. There can be penalty APRs if you're late. Late payments can be reported affecting your credit. Now, when it comes to credit, you have to think of credit as a big picture, guys. When it comes to getting insurance, when it comes to getting a loan, getting a mortgage, getting a job for a majority of people, credit is going to play a major factor in that, as a majority of places do pull credit and have a lot of correlations when it comes to credit reports that they are pulling. Number three, carrying a balance is going to incur a very heavy interest charge. That is the big thing, guys. You have to make sure that you're paying it off. If you're rolling over a balance from month to month and you're making that minimum payment, that is where we really recommend two different things. Either one, using the debt snowball method. So what this method says, list all of your debts, guys, from the balances. So this, you're going to focus on the balances. Your lowest balance card is going to go first. Every single penny over the minimum that you're paying on the card. We want to ensure you're paying and making all of the minimum payments, but every single penny you have over that minimum payment is going to go to the lowest balance card. Once that card is eliminated, or that deadline, whatever it may be, is eliminated, you are going to snowball that into the next debt, so on and so forth, until all of your debt is gone. Now, this method, of course, has a large psychological factor. When you start seeing the ability and you start seeing yourself knock out debt, it really does create a snowball. And again, a lot of it is psychological, because once you start seeing that you're able to eliminate debt, you're able to pay back debt, it is a very, very, I would say, toxic feeling, and a very empowering feeling to get it done and get it down faster. You will see that once you start this ball rolling, guys, like they say with a giant debt snowball, is you're going to knock it out really fast. The second method is the debt avalanche, which is my personal favorite, but this takes a lot more discipline. So what this one does is, mathematically, you take your highest interest rate to your lowest interest rate. So it is not focused on balances. It is focused on the interest rates that you are paying, because dollar for dollar, the most impact is going to come by putting the most money at the highest rate. So knocking that one out faster. Now, again, this one doesn't quite have the psychological effect of seeing the debt elimination as fast. And it also depends on your balances. Because if I have a card that has a $10,000 balance and it's at a 30% APR, and I have another card that has a $10,000 balance that's at a 12% APR, knocking out that $30,000 or that 30% interest rate is going to have, again, a lot more impact and a lot more benefit dollar for dollar when you do look at that. And number 4, we get into applying for too many credit cards, guys. This is really, it is a hard inquiry when you do a credit card, which means that is a credit check. Now, the credit checks are 10% of your score. So again, it's going to have an impact with that. Now with this, again, you're messing with the capacity. If you're closing out cards, you could be messing with the length of your established credit. So the credit history that you do have there. My personal opinion, guys, is have one. That is right, guys. Have one card that you really that you utilize on a regular basis. Now, I do not recommend, regardless of what other people say, I do not recommend doing store cards at all, guys. Store cards can only be, a majority of them can only be used for very specific places, but overall, the APRs we see on store cards are a lot higher. If you're saving 15% at Kohl's, if they're saving you 25% at Old Navy, it is not worth it in the long run, guys. Most people get these cards having the best intention to pay it off, and most of them don't. Even when you're looking at the 12-month same as cash, which I know like Best Buy does, or you do the 36-month same as cash, which we see at Gardner White, guys, this is not the way to do it. You're borrowing, you're literally, and again, the way that I kind of do the analogy is you're kicking a can down the road for debt that you're going to have to pay in the future with money that you don't have now. So there's nothing going to say in the future that I'm going to have a lot more money to be able to repay this debt, which is the reason, guys, once upon a time, years ago, people used to save up money and buy things with cash. It wasn't the credit card society. It wasn't the loan society. It was saving up and paying for things with cash, which meant you have enough to buy it and you're not paying additional interest. Now, big picture, again, thinking of this, if you're borrowing, let's say $10,000 on a credit card, by the time you pay that off, if you ever pay that off, most people are paying $13,000, $15,000, $17,000 on that credit card that they borrowed 10 grand. And again, you have to put it in perspective with, number one, how many hours do you have to work to just pay the interest on that card? And two, how much of your paycheck are you giving away on a monthly basis to just carry stuff that past you bought? Most people don't keep around stuff that long, but when you are sitting on a bunch of debt, it can sit around forever. I mean, we're talking months, years. There's people that have student loans for 10, 20, 30 years, depending on the profession, which to me is crazy because you have the interest running for that amount of time. And the final one, guys, is using too much credit. This, again, goes right back to your credit card utilization ratios. Companies want to see it about 30% or less, which means you have a 30% utilization on a card. This, of course, can be greatly affected by the limit you have on your card. For instance, if you have a card with a $1,000 limit, 30% utilization is $300 or less on that card. Now, of course, the credit card companies really look for two different things, guys. Number one, did you make a purchase? Number two, did you make a payment? That will keep your credit open and active. And of course, you never want to put more on cards than you have the ability to pay back in a single month. The majority of younger individuals that are starting to establish credit, And I know as much as a lot of people do not like credit cards, guys, it is a tool for establishing credit, period. It is not an open line of credit to borrow money unlimited. It is not a tool or a credit card that is used to supplement your income. It is literally there to build as a credit utilization or a credit score building tool. When used properly, works incredibly well. You have to be very disciplined with it. Now, in addition, guys, big pushback that I always get is the rewards. I love the rewards. For a majority of people, which is a very, very small percentage that pay their cards off in full every single month, there might be, again, a very small usage factor that people have. But remember, the rewards that you're getting are paid for by someone else. That again, thinking big picture, thinking of the United States, if you're getting reward miles, if you're getting cash back, if you're getting any of those, even if you're winning against the credit card companies, which some people kind of coined that phrase, getting ahead or beating the system, guys, it's a rat race. There is no system. They will always win at their own game. Even if it is not you paying in the money and the dollars, there are $1.1 trillion in credit card debt for people that are paying for the rewards that you are accumulating. So guys, that'll do it for the dangers of credit cards. You have to be very, very diligent about them and make sure that you're using them the way that they were meant to be, not overspending like we've seen in the past. So let me know in the comments what you guys think about the dangers of credit card debt. And as always, thank you guys for watching.